Welcome back, investors, to Ticker Time News. I'm Adam, and today I wanted to talk all about the SEC's vote to advance the biggest changes to stock market rules since the mid-2000s, aiming to give small investors just like you and me better prices on our trades, and of course, reduce some advantages enjoyed by some of those high-speed trading firms. You know who I'm talking about. However, I'll have to move this story to the back burner for now, as we have something else that we need to focus on, and that is the Fed and what the Fed did to the markets today, okay? So let's go with the Fed today. Today's trade started on a more upbeat note as market participants awaited the FOMC decision, the updated summary of economic projections, and Fed Chair Powell's press conference. Now, a range-bound trade had the main indices slightly higher, with the S&P 500 pushing past its 200-day moving average, which was at 40.32 today. Now, the initial positive bias was seemingly oriented around the hope that the Fed might throw the market a carrot today with its monetary policy outlook, and that Fed Chair Powell would take a less assertive tone, be less aggressive, less hawkish, right, in his press conference. But as we all know now, that was not the case. The main indices quickly declined in the wake of the decision to raise the target range for the Fed funds rate by 50 basis points to 4.25 to 4.5%. And the indication in the summary of economic projections that the median estimate for the terminal rate in 2023 had been raised to 5.1%. And I told you guys for months leading up to year end that the Fed was pushing to go 5% or higher. And now they have it in their summary of economic projections at 5.1% versus, you remember back in September, the projection was 4.6%. So they took it up another 0.5% for their target rate. Now, the S&P 500 went from 40.50 just before the FOMC announcement to 39.66 during Fed Chair Powell's press conference. Afterward, though, it moved back above 4,000 before being met with resistance again at its 200-day moving average. Now, the rebound move was remarkable because Fed Chair Powell spent most of his time at the press conference talking tough on the need to get inflation back down to 2%, saying it's going to take substantially more evidence to give confidence that inflation is on a sustained downward path, meaning yesterday's CPI report at this moment in time is just a one-off case, and inflation could creep back up. Also, the Fed expects to sit at its terminal rate, which now is projected to be 5.1% for some time. How long is for some time? Is it 3 months, 6 months? Well, the data is going to lead the Fed, like Jerome Powell has said for months now, on that decision as well. He eventually added that while he thinks the Fed's policies are getting close to the level of sufficiently restrictive, which would be the 5.1%, the Fed's focus is not on rate cuts. Thus, there is no mention of rate cuts in the summary of economic projections for the entirety of 2023, meaning in the Fed's eyes, a Fed pivot is nowhere in sight. Now, we believe a Fed pivot may not come until late 2023 or early 2024. Now, of course, that all depends on the data and the economy and jobs. Those are the three big things. Moreover, as this was happening, other moves were being made elsewhere in the market. The Treasury market, for example, it saw a rebound from the selling it suffered immediately after the FOMC announcement. And can't forget about the good old greenback. The US dollar index came in under renewed selling pressure too, falling to 103.62 at the close, a level not seen since back in June. Now, the dollar is staying within its falling wedge structure, so at least that's something that we could hold on to. Now, the action in the stock, bond, and currency markets would suggest that market participants don't think the Fed will have enough runway to take it off all the way up to the terminal rate north of 5%. The reason being is that there is an underlying expectation, or maybe it's a fear, that the lag effect of prior rate hikes is going to undercut the economy enough to preempt a move to the elevated levels envisioned in the latest summary of economic projections. Now, that does not mean it is off to the races for the stock market, because the residual implication is that economic activity will be weakened to such an extent by the prior rate hikes that earnings prospects will be greatly diminished. Therefore, the willingness to pay a premium for every dollar of earnings will be diminished as well. So, what did you think about the Fed today? Did they make the right call on rate hikes? And what do you think about going higher for longer? Their motto for the past few months, higher for longer, they're doing it. Okay, let me, real quick, before I dive into your questions, I want to tell you about tomorrow, just real quick, okay? So looking ahead to Thursday, market participants can take their, market participants cannot take their eyes off the road just yet, as we have got some more economic data incoming. At 8:30 tomorrow, we get November retail sales. The expectation is a negative 0.1%. The prior reading was a positive 1.3%. Retail sales excluding automobiles. The expectation is a positive 0.2%. But the prior reading was 1.3%. So there's a big reduction here in retail expectations. We also get the weekly initial claims. Expectation is 227,000. And the prior reading last week was 230,000. And then continuing claims. The prior reading was 1.671 million. Also, the December Philadelphia Fed survey, the expectation is a negative 10. Yep, a negative 10. However, that's a little bit better than last month when that reading came in at negative 19.4. And then lastly, we get the December Empire State Manufacturing Survey. This one's a rough one. The expectation is a negative 1. The prior reading was a 4.5. Now, let's go to your questions. I know you have them, and that's what this live stream is for. All right. So let's see. That was a lot. That was a lot to take in. I do want to look at the charts too to see what we're looking at here as far as a setup and where I think this chart might go for the remainder of the week. Okay. But I want to make sure I get your questions first before I dive into the charts, or we can just go back and forth as you come up with any that you want to ask. Otherwise, that was a mouthful, and I want to dive into the charts. Good evening. Let's see here. In recession, does oil prices fall? Do you think real estate fall in 2023? Okay. When a recession hits, what happens? Well, growth in the economy slows down. Slows down. Think of the lockdowns, how the economy just came to a halt, right? Well, it's not that bad in an economy like the lockdowns were. However, growth slows. Businesses have less sales. Consumers have less money to spend. There are a high number of unemployed consumers out there. That makes people feel nervous. That makes people feel fear, okay? When that occurs and consumers aren't spending, companies are making less revenue or bringing in less revenue, then people are also driving less. They are basically driving to work, back to home, and that is it. And also, we have to take into account this time around in this recession in 2023, we are looking at a work from home crowd that during our last recession, big one back in the 07-08 great financial crisis, we didn't have a big chunk of the workforce working at home. This time, we will. Now, I know the number of at-home workers is shrinking as more employers want their employees back in the office, but that also has to be taken into account. So, with that said, yes, oil prices do come down. Now, it's not beneath OPEC Plus to cut production to such a level that they inflate the price of gasoline, the price of oil, okay? So in a normal, typical recession, yes, oil prices come down because there's less growth. There's less tractor trailers on the road delivering product from hub to retailer. There's less trains choo-chooing around taking product from the manufacturer to the distributor to the retailer or wherever it may go. There's less of all of the activity. Transportation comes down. There's less air traffic because people aren't taking vacations because they've got to save every penny they have. And when you add in inflation that is high, you add in the slowing economy, oil prices come down. But when that occurs, we have to pay very close attention to OPEC Plus and their actions because they control a large supply of oil and the production of that oil. Next up, do you think real estate fall in 23? I do. I think real estate prices, and let me just throw it up here on the chart. Real estate prices are correlated, meaning they have a ebb and flow to them with the 10-year yield, the U.S. government bonds, 10-year. When the 10-year is coming down, that means that mortgage rates are also coming down, which Jerome Powell at the Fed, he doesn't like that. He wants to see the 10-year go up, and he wants to see mortgage rates go up, because when the 10-year is up, mortgage rates are up, and they get to such a high level, it prices many consumers out of the housing market, meaning less buyers, more sellers, prices come down. We've already seen prices come down slightly, just a little bit, but not nearly enough. So, in a recession, that should translate to a slowing down of home purchases. It should be an increase in mortgage rates. As the Fed funds rate goes up, so too should the 10-year yield, the mortgage rate. Less sales. All right. Excuse me there. So I do think real estate will come down in 2023. By how much, I don't know, because it is still holding up strong. Stronger than I would have imagined at this point in the game. But as long as employment is strong, housing prices will remain strong too. Okay? People don't really freak out until they're nervous about potentially losing their jobs, and they're nervous about well, if I lose my job, how am I paying my mortgage? Okay. So I do expect both of these events here, oil prices in a recession, to come down. There is less transportation, less growth, less of everything. And home prices, I believe, should come down as well in 2023, especially during the recession. And myself, in my current situation, I am looking to buy a home. I wanted to buy last year, but interest rates shot up right as I was ready. Well, I had been ready for months, but hadn't had the right house come around, if you know what I mean. And then we ended up getting priced out of the market because interest rates went up too high. So perfect example right here of being priced out of the market for taking a new home. So I hope those answers help. I try to give it enough, not just saying, yeah, they'll go up, yeah, they'll go down, but giving you some information for why they will go down or why they will go up. So if you have any more questions, please feel free to put them in the chat. We'll go over them. Absolutely. Okay, let me go to the SPX, which is the ticker for the S&P 500. Now, the candle today is a spinning top. It is bearish in context, but I want to share a couple things here with you about the setup that we have here. Now, if you look at where we are, okay, and I'm just going to go right up here, and I'm going to draw this box. And what do you see? What do you see? For the past month, little more than a month, we have been chopping around in a tight trading range. Sure, prices have shot up, prices have fallen down, but we have been in this range for nearly a month. I want to point out several more things here. One of them being, and let me get this right here. And let's go up here to it. Right here. This level here. And I'm going to click on it and make sure it's in there right. It should be 40.20 or about 400 to 402 on the SPY. 40.20. That is exactly where yesterday's low was. I believe it was like at 39.19 to be precise, where it closed. But that point right there, 40.20. I didn't mean 39.19, 40.19. But right here, this number, 40.20, to me, it's a significant number. And let me make that line thicker so you can see, okay? If we move over here just a little bit, this purple vertical line, all right, that is the first trading day of January, meaning the spot rate before it is the last trading day of 2022. Now, if we just extend this 40.20 line right out to the last trading day, okay, the last trading day, and let me make sure we are still locked in on 40.20. This side wasn't. 40.20. Notice something here. Notice something for me. Right there at that 40.20, what do we see? This is getting interesting here. Let's open up a circle so we can see it. If we just continue to chop around in this box and move sideways for the rest of this year, today is December 14th. There's not that many trading days left. If we just continue this cycle of moving sideways right on the last trading day, Friday, December 30th, 2022. That's the last trading day of 2022. If we just move sideways, we will end up being right at 40.20 to close out 2022. Now, I'm not saying that we're just going to have flat days from here until December 30th. No. What I'm saying is this yellow box that we are in, we're just going to continue to trade sideways in that yellow box until we get to the end of 2022. Does that make sense? What do you think about that forecast? For me, that's where it's at. That's what I'm thinking. Sure, tomorrow, we could come in and see a day tomorrow where we're just declining. Maybe we go to that, come all the way down to the 3,900 level, which is extremely significant. 3,900 or 390 on the SPY is a significant level on the chart. There's a ton of support there, a ton of support. And that would be a big decline. The lower end of the weekly expected move is all the way down at 38.23. Let me get my highlighter. Down here, that purple line, that's the lower end of the weekly expected move. Right here is the upper end of the weekly expected move at 40.45. Okay? Something else that I want to point out to you. There's a dotted line. It's really hard to see. It's just a hair above the upper end of the weekly expected move, but there's a dotted line there. That dotted line is at 40.50. That is the quarterly expected move on the upside. So we got December, November, October. Those 3 months, okay? Just like we can do the weekly expected move, we can do monthly expected moves, and we can do quarterly expected moves. 40.50 is the upper end of the quarterly expected move, which ends December the 30th, the last trading day of 2022. And it falls in our circle here, just above, of course, the 40.20, where I think we could probably end up the year sitting at on the S&P 500. And that's right around 400, 402 on the SPY. So just a couple things to think about, all right? All right, take those markers off, clean this up. Now, with this spinning top, this is a bearish candle. And let me go over here to our candlestick, and let me get our drawing tool, make sure it's good and ready. Over here on the bearish side, right here, we have ourselves a spinning top candle, okay? The candle itself is just like a medium-sized body, and it's almost got an equal wick on the top and the bottom. It's a spinning top. If it is red, if it is a down day, it is considered a bearish spinning top. Now, just so you know, if it was a green day, right, and we had that same exact candle, it would be considered a bullish sign, okay? So, not to be confused, what we got today, that candle is a bearish spinning top. You can, it's hard to see. You probably can't see it. You can see the candle right here, okay? And then there is a wick on the top and there's a wick on the bottom with almost equal proportions. Spinning top. Now, if you take into account that the day before peaked out at the bear market trend line that has stopped every single major rally in 2022, including on December the 1st, which was this candle right here, and just yesterday, December 13th. if you take into account that we reached resistance and we're pulling back from that, okay? And then we get a spinning top candle today that was also bearish, closing below not just that trend line, but the 200-day moving average. Those things add up to a pretty bearish outlook in the near term. One other thing to take into account, the 5-day EMA and the 20-day moving average. We closed above those two moving averages. They can act as support to hold price up. So if we are using those two moving averages and just say they move out sideways while the resistance line is angling down, we're coming to a point right here at the 40-20 for the end of the year. Let me know your thesis, your thoughts on what you make of these candles and where we're going to be by the end of the year. Now, we could be higher, we could be lower, but I'm just taking the recent history of price action, what the Fed said today, especially in the summary of economic projections, and how the Fed is going higher for longer, and it just makes sense to me. All right, I see a few more questions. Let's go here. Can you please elaborate on how to use, or I'm sorry, how you use the weekly expected move info, trading decisions, in and out points? Wonderful, wonderful. I've done this a few times before, so absolutely. I'll give you an example, okay? And I'm just going to use right here this week, okay? The weekly expected move, all right? So every Sunday evening, I send our private investor community an updated list for the coming week of the weekly expected move. There's an upper range and a lower range. Now, 68% of the time, by the end of the week on Friday, when we close business on Friday, price should fall between those 2 points 68% of the time, okay? And it's considered a 1 sigma move, all right? I know my numbers aren't that great. So 68% of the time, this is where price action will end by Friday close of business. Now, the numbers are generated by an equation using options market data. And it starts from Friday, right? The data is compiled over the weekend, and then it spits out a number that goes through 1 week to the following Friday. That's where the numbers come from. Now, the way I play these is not as support and resistance, okay? They're not support and resistance. They're almost like one tool is to use them to help you manage risk, okay? Another way is to trade around them. And when I say that, let's look at yesterday. As a matter of fact, let me clean this chart up here just a little bit. And I'm going to go to the 5-minute chart. It may make this a little simpler to understand and see. Give me just a moment to adjust the chart to make it a little easier. Let me clear off this that yellow bit. Okay. All right. Let's open this up some. Again, just give me a quick minute. I want to go to yesterday, and I can use this morning too. So let's start here this morning. This candle, let me get my highlighter. This candle right here is 9:30 a.m. Eastern, all right? This is when the stock market opens its cash session. Now, price opened down. It gapped down, slightly, just a little bit. But during the morning, price action, it rose, right? And it got to the weekly expected move, which is the purple line right here running across the screen, okay? Just like so. And late morning, it gets to the weekly expected move, okay? Sometimes they can act as magnets, right? Drawing price to them when they are close to them. Not when they're far away, but when they're close to them, they can act like a magnet. So once price breaks above, like it did right here, price broke above the weekly expected move. That could be a sign that, okay, I know 68% of the time it's going to come back down and be underneath that line. So I may take a short position at that moment, right? Maybe wait for price to slow down, give me a sign of reversal. And if we look kind of closely, we do have a bit of a signature here on the 5-minute chart, right? Right here, this candle that has got a little body right here, but it's got a long wick on top. That could be considered a hammer candle. And let me just show you on right here. Okay. My apologies, not a hammer. What am I thinking? Okay, right here. Shooting star. Okay, right here. When price is moving up and then you get a candle with a small body and a long wick on the top, that is a sign that price could be reversing, all right, to go back in the other direction. A shooting star. My apology for getting that hammer candle mixed up with it. All right, so a shooting star candle. That's a sign that price has gotten to a point where it does not want to go any higher. Taking a short position there and riding it until we break back underneath the weekly expected move. And then once price settles out, right? Or our stop loss is really, really tight, and it should be if we're trading around these weekly expected moves, keep that stop loss tight because it may not be a big move. It may be 1/4%, 0.5%, or maybe you can get lucky with 1% or something. All right. So it's typically a smaller move if you're looking for a day trade. Swing trade may be a little bit different. Okay. So here we reached a plateau where price flattened out. That may be a good exit point. And there you go. That was a real quick short on the S&P 500. Okay. Now, if we move forward in time, still on today, right? Right when we reach this area of support right here, right there, right about, what is it? The 200-day moving average, 40.39. We found support there. Price started to move back up. We know it's a magnet. You could have potentially taken a long position here, ride it until it breaks out of the weekly expected move, and then sell. Sell right there. So that's how you can trade around the weekly expected move. If price is out of it, it's going to come back down into 68% of the time. And then if you see price starting to break up, it could break up above that weekly expected move. Okay. Now, of course, today, in hindsight, it's 2020, but let me just clear these the chart up here real quick. Almost got it, and then I'm gonna go right over to it to show you. Okay, let's just go over here. So hindsight is 2020. Being above the weekly expected move right here, right? The data comes out, you know, it's going to go back into the weekly expected move or underneath it when we're on the top side. Then boom and boom, there was a 1.4% drop in the S&P 500 right at 2 p.m. today Eastern when the press release came out about the FOMC. Okay. All right, let me just clean this up here real quick, and then we're going to go just one more day in the past to give you another example. But the gist of it is when price gets above the upper end of the weekly expected move, look for shorting opportunities. When price is at the other end of the spectrum and it is trading down by the lower end of the weekly expected move, that's when you'd want to look for long positions because price action should come back up above the lower end. All right, let me move forward back one more day and give you an example. Now, with the big move on CPI, okay, that was a huge move. There is no way price should have been supported moving this far, this fast on cooler than expected CPI that was still high inflation. 7.1% for perspective is closer to peak inflation than it is to the Fed's 2% target. Just think about that for just a moment. Perspective. So the weekly expected move, here it is. It was gapped up over instantly before the cash market. So we open and we are sky high, way up here, right? Many people probably thought the market was just going to continue to rise and we're going to get a big 5% move. No, not yesterday. So yesterday, I used the weekly expected move and the breakdown from it to actually go short. And I stayed in it into the close, and then I closed out the position right at the close. But here we see we're way above the weekly expected move. We know price likes to come back to it. It's a magnet. So watch it. When price starts to fail and break down, right, where did it come to? It came right here to the weekly expected move, which even though they're not support and resistance lines, they can be an area of, what word should I use? An area to be aware of, okay? Because price, just like yesterday right here, it just doodled around, not really using it as support or resistance, right? It just bounced around and kind of held there for a moment before it started to fall further. So taking a short position when you know you're above the weekly expected move, coming back down to the weekly expected move, and then breaking below the weekly expected move, okay? And I'm all talking about the top side of the weekly expected move, not the lower side. You short when price goes above the top line, and you go long when price is under the bottom line of the weekly expected move. I hope this is making sense. I really do. Okay, let's bring this chart back together a little bit here. Still on the 5-minute time frame. I don't think there were any other relevant interactions here this week with the weekly expected move. Let me just open this up real quick and adjust this chart. Okay. All right. And just since we just did those examples up here on the upper end of the weekly expected move, for example, if price action was down here around the lower end of the weekly expected move, if price broke under, then here I'm looking to go long, because 68% of the time we're going to go back up and be within the top and bottom weekly expected move. Okay, so go short when you're along the top and price breaks out, and you can go long when you're on the bottom and price breaks down. All right. All right, let me clean this up. I see your question there about static. It is fluid. Okay. The weekly expected move changes daily or static for the week. The weekly expected move, it stays the same for the week, okay? Because it's based off of options data from the prior Friday that is good until the next Friday for 1 week, okay? There are, I could call them daily expected moves, which are very fluid, okay? They move daily. We've actually released them a few times to our private investor community, and they're really, really used for risk management, okay? Especially the daily expected moves. We're working on it behind the scenes. It's not a product that we've launched yet. We still want to make sure we're working out the bugs, the kinks, so it's all good. But yeah, it is interesting. Okay. So it both the weekly expected move, it's not static. It can be fluid, but it is supposed to be used from Friday to Friday for 1 week. Daily moves, yes, extremely fluid, change day by day. Sometimes they can even be updated in the middle of the day when you're looking at a daily expected move, as I call it. I don't know what the official name of something like that might be. All right, let's see here. Found a web. Let me move my cursor out of the way. I found a website that I'm curious about your opinion. I don't want to seem like I'm spamming, but I can post a link to the page I'm interested in the most. It has free weekly expected moves for some. Yeah, go ahead. No, it's okay. Go ahead. Absolutely. Post away. Absolutely. Anytime. Feel free. You're not spamming. You're asking questions. And I want to be here to help with whatever I can. Now I'll pull it up as soon as you post it. I think the comment section allows links. Yeah, I'm pretty sure, because we get those spams. I'm surprised we haven't gotten any. I better knock on wood. We don't get any today. Okay, while you're doing that, let's go look at the SPY real quick. I think the information is just copy and paste from the SPX. We're looking at the same thing, about 400 for the end of the year, maybe 402, between there, low zone. We got a spinning top candle. Again, it closed below its 200-day moving average. It closed below the trend line, bear market trend line. Yeah, those bots. Yeah, they post links all the time. I've never clicked on one, and I never will. I try to delete them when I can, but I can't delete them during the live stream. I have to wait till the live stream is over before I can even attempt to delete them and block them. But once you do, they just come up with new accounts and they just do it all over again. All right, let's see here. The SPY, yes, same candle under the trend line, under the 200-day moving average, but above the 5-day moving average and 20-day moving average. Use support right around 395, which is like perfectly right through here, 395 as support. It has held multiple times in the last month, but like I said on the SPX, for the last month, I mean, look, we've basically been trading in a box, all right? That's not going anywhere. It seems like we're making these big moves up and down every day, but we're not going anywhere. We're just moving sideways. Okay, my link isn't showing up on your chat. I can send it, but not showing up. Yeah, put it on Discord. That's fine. I can open up Discord and click on it, or even after the live stream, I can do so and message you back about it. That's fine. Go ahead. I know links are can be posted either in the public or private Discord. Is it channel? Is it called a channel? Yeah, I'm not very familiar with Discord. I know how to use it, but I'm not very familiar with the terminology. All right, so that's the SPY. Yeah, 395 to 400. It seems like we're trapped right in between those two numbers. Now, the Q, a little bit of a different situation. IDKM 2.0. First of all, you are welcome, and I'm sure you're not too old for it. I'm sure you got it. I'm sure you got it figured out. There we go. And I'm sure you're just fine with using that technology. Okay. All right. On the QQQ, let's tighten this up a little bit. A little different story because the Q has not tried to tag its downsloping trend line, but look, same thing. We're moving sideways. We're going nowheres. We're running in circles. That's what we've been doing. There's big moves like November 30th. There was a big 4.56% day. The next day we went nowhere, and then we started selling off right back to where we started, okay? So for the Qs, that kind of support line is right around 280. And then on the top side, it's right around 295, 293 in that little zone there. So again, we're going nowhere, just moving sideways within a box. All right, so that's the Qs. And again, it has not even tagged that downsloping trend line that has been used all year as resistance. So I think we're just going to continue to move sideways. And when we get to that vertical line right here, this is the start of 2023. We're liable to just seriously move sideways until we get there. Just like this. There. Stay right within that zone. No Santa Claus rally, nothing. This is the probability that I'm seeing right now. The other probability is that we sell off. And if we sell off, I don't think it's going to be fast and move quickly. But if we do get the 10-year rising, the dollar rising, then we could sell off slowly until we get to the end of the year. Either way, you could probably place yourself a bit of a triangle on your chart, and that'll probably be the area where we finish out the year. Okay. All right, let's go to the dollar real quick. I do want to point out on the chart here that the dollar is still within its falling wedge structure. It's also still within its weekly expected move, okay? So even though the dollar has given up quite a bit, and I want to back this up a little bit to show you where the dollar is and where it's come from. The dollar, big, strong move down, right? Expansion leads to contraction. And now price is just contracting in this falling wedge. Now, when we are moving down in a structure like this, let me go show you over here on the chart patterns. We have a falling wedge, which is right here, okay? Price fell, price expanded. Now price is contracting in a falling wedge. That typically means we're going to see a reversal, okay? If we see a reversal in the dollar and it starts shooting up, what does that mean for equities, especially the SPX and the SPY? That means pressure will be applied because a dollar moving up means the S&P 500 is moving down, okay? All right, so that's that. I am keeping a close eye on the dollar. Now, where the dollar is right now in conjunction to any type of support, we have to go all the way back here, right there. June 16th, okay? June, what is this, 27th. And then if we go back further, we're looking right here and right through this mess where it kind of bounced around that 103 level. Now, in the after hours, which makes me a little concerned about tomorrow for equities, at least at this point right now, bottom right corner of your screen, you see the flashing black and green and red. That's what the dollar is doing right now. It is up 0.2% in the after hours, okay? It closed today, what was it, 103.62 maybe? And it's at 103.82 right now. So it's moving up. That's going to apply pressure on equities if it does move up tomorrow, okay? So we have to keep an eye on the dollar because it's controlling or dictating where other equities are going to go, okay? All right, we looked at the 10-year already. The 2-year is interesting. All right, the 2-year yield, I should say, because it's holding up pretty well, okay? Now, it did have this structure here, and let me just open this up a little bit and pull it down. I love this new live streaming software I'm using. TradingView just moves so quickly and smoothly within it. No more lag effect. Okay, so if I adjust this just a little bit for the new couple of days, it did break under this line, but I could adjust it out like this, capturing 3 points. And you need 3 points or more to have any confirmed trend line. This to me is looking a bit bullish, okay, on the 2-year. But something interesting happened, and I want to go, how should I do this? Yeah, look at this. It's almost like looking at a dragon or something. That's crazy. But the 2-year wasn't always low. It has had its peaks. I want to get it as much as I can on here, far back as time. I want to add the Fed funds rate for just a moment, okay? All right, so now let me go over here, and I can type in Fed funds, click on that. Now that's been added to the chart. Something that was pointed out to me, and I don't know where we should be to get it lined up. I think this is it right here. And something was, this was the statement. The Fed funds rate, okay? Oops, it moved. Let me back that up. The Fed funds rate, you know, it peaked right here, and then the 2-year peaked, you know, basically when the Fed stopped raising rates and held, just like the Fed wants to do in early 2023, the 2-year stopped rising. Well, you see right here, rates are still going up. The 2-year has been, but it's slowed down, okay? So I'm waiting for this thing to just pop out. And, oh, that's not what I meant. I don't know why my highlighter's not staying on. I'm waiting for the 2-year to pop out, okay, and start moving higher. That's what I would expect. But if we went back further in time, and the correlation is going to be mixed up here just a little bit. I haven't done this before, so I am trying it new here with you. I don't think my Fed funds or the 2-year yield is going back far enough for me to use this properly. Okay, well, I'll have to figure this out, maybe take some screenshots and share it that way. But my point here is, look right here at this correlation. When the Fed funds rate is going up, the 2-year yield goes up too. When the Fed stops raising rates, that's when the 2-year also stops. We know the Fed is not done raising rates. We know that the Fed will, on February the 1st, raise rates again. Now, it's looking like, according to the Fed Watch tool, that it's going to be 25 basis points. But there is a smaller probability that it could be another 50 basis point rate hike. The data from now until then will drive that decision. But my point with this little experiment here is that as long as rates continue going up, the 2-year will also continue to go up, which means I don't know. I don't really know what this data means, but it's something I saw and I wanted to share it with you, and I'm kind of trying it out here as we go. But it's interesting. Okay, so it may give us it may be that it's a leading indicator for when the 2-year yield is going to stop going up. Once the Fed reaches its terminal rate and then it holds, that's when the 2-year is done. It has peaked and it will start moving down from there. Okay. Great correlation. You can see it there. The colored lines is the 2-year yield. The orange line is the Fed funds rate. And this is back going from 04. It rises up to 06. They stop and hold their rates through 08, and then through 08, 09, and even 010, they're bringing rates down, the Fed funds rate, which also lowers the 2-year yield. Neat little experiment here. All right. Well, if you guys have any other questions, plug them in now. Otherwise, I'm going to wrap this live stream up. I do want to thank you for joining me today. I know I shared a ton at the very beginning of this video. I had a lot to spit out, but I got it out there. maybe slow the video down if it went a little too fast, or speed it up if it went too slow, whatever your preference. But I hope that information helps. I don't see this market going up and reaching new all-time highs, okay? I think there's a lot of pressure on this market, downward pressure on this market still to come. And we haven't seen the worst yet, not one bit. Missed it, but thoughts on FTX? Oh man, that is something. I do find it, I gotta be honest, I may want to get my tinfoil hat on at this particular moment. Actually, I'm going to do this. My son's going to be extremely happy with me. He made me this little hat right here, okay? This little hat, and he wanted me to wear it live. So I'm going to use this as my tinfoil hat. Wouldn't it be interesting? Sam Bankman-Fried gets arrested the day before Congress is expecting his presence, his testimony under oath. But he's arrested the day before that happens. I don't know. Is that too conspiracy? Is that too much of a conspiracy theory? Here, I'll take my tinfoil hat off. Now my son is going to be so glad that I actually wore that during a live stream. I've been thinking so hard how to work that into the live stream. But anyways, oh boy, that was good. Yeah, thank you. I appreciate that. Absolutely. Man, FTX is just an absolute mess. There was like nothing in place at all to protect the company. No insurance, or not enough insurance in some cases, and no insurance in other cases. And just Sam Bankman-Fried writing a loan document, signing it, I am the lender, and signing it, I am the lendee. What? Are you serious? Are you serious? You're gonna give yourself a loan, and you're the one signing both sides of that loan? That is just, oh my gosh, I can't believe that actually happened at that company. And the CEO that's there now, when he testified under oath for Congress, I mean, he said that it was just embezzlement, old-fashioned embezzlement. It was just scary how Sam Bankman-Fried took everyone's money, laughing the whole time, and using it allegedly for his own use. It's just absolutely crazy. All right, so I guess that wraps up the questions. I'm glad we could have a little laugh here at the end. That was good. If you missed it, go back to the beginning. The first like 10, 15 minutes, there was some good, honest information that can help you kind of digest and understand what the Fed did today. Going forward, again, I think we move sideways. We'll have some downward movement. We'll have some movement up, but I think from now to the end of the year, Friday, December 30th, the last trading day. Oops, I got to remove the Fed funds rate here. The last trading day of the year, I don't really think we're going to go anywhere, right? We're in a chop box, and that's where we look. It looks like we're going to remain. I'm saying about 40-20. Maybe I'll call it now. 40-20 might be where the S&P 500 SPX ticker may end up being for the year, but we shall see, my friends. Okay. All right. So let me just throw this on here real quick as we wrap this up. I want to move that, and I want to put the chop box on here just to help you identify it. And my circle, 40-20, is like right there in the middle. I mean, we could make some big moves up or down and still remain in this chop box. All right, ladies and gentlemen, thank you so much. Yeah, it is. All of a sudden, Sam went from genius to goofball. You are absolutely correct. I wish I could like these comments. I really do. All right, so we'll wrap it up here. Thank you for joining me. I'll be back tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. And of course, any other news like that SEC vote. I want to talk about that. I'm itching to talk about that. Yeah, if you don't know, very beginning of the video. So the first thing I mentioned, we'll talk about it tomorrow, because FOMC and Fed should be on, we should be behind that. So we'll talk about that tomorrow. It's good for retail investors just like you and me. Really good news. So everyone, have a wonderful evening, and I'll see you in the next video. Have a good night.